I'm Mark Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Today's guest is a long-standing executive with an incredibly strong resume, who is the founder and CEO of one of the legacy sector's most respected outfits. Bill O'Farrell is CEO of Premia Holdings, and as such has an excellent overview of this rapidly maturing segment of the market. In the podcast, Bill and I look at the state of the legacy market and how it's likely to be interacting with the live market going forward. At a time when the live market is undergoing one of its periodic crises of confidence in US casualty, it's particularly valuable to talk to someone who has spent much of his career making a living out of taking on and managing long-tail liabilities of all complexions. We also examine how the structure of the legacy market is evolving towards a partnership model in which repeat transactions with live market counterparties are much more likely than in the past. We also look at innovation and the best applications for AI within legacy, as well as the prospects for an important role for the sector to play in the nascent casualty ILS market. Bill's not only incredibly experienced and knowledgeable, but he's also very easygoing and really enjoyable company. And the next half hour will pass by very quickly. Enjoy the podcast. Bill, welcome to the Voice of Insurance.
Thanks, Mark. Pleasure to be here.
For anyone who doesn't know you, why don't you introduce yourself and run us through your career to date and how you got to the position you're in now?
Okay, Mark. I'm currently the CEO of Premia Holdings Limited, which is a global insurance and reinsurance group focused on the legacy market. I was employee number one, co-founder and CEO of Premia since 2017. Prior to that, I joined Arch in 2016 as executive vice president, essentially to set up Premia. Before that, I was at Chubb, formerly ACE, where I was the chief reinsurance officer for roughly 13 years. And it was a great time to be at ACE and Chubb. We went from an $8 billion company when I joined to a $65 billion company when I left.
So you were originally the legacy ACE part of Chubb?
Yeah, that's right. I joined in 2003 when the company was $8 billion and then reinsurance recoverables of $14 billion. And that was my first role, essentially.
A huge journey to have gone through because, of course, at 2003, ACE was still, I suppose, digesting some of the large acquisitions that it had made. It was probably just over digesting them by then. And that was an amazing company to be in and to have stayed all that time as well.
Oh, it was fantastic. Yeah, I really welcomed the opportunity. I was, I think, Evan Greenberg's first global hire in 2003, and it was a great place to work. Loved it. Prior to that, I was at Berkshire Hathaway, originally in Omaha, Nebraska, and then I moved out to Stamford, Connecticut in 1994 to work for Ajit Jain and worked on a lot of legacy transactions and ran a bunch of the deals that they did in that space from basically 94 to 03.
Wow, that's quite the resume. So when you were in Omaha, was that within that tiny office, this legendary office of only sort of about 17 people or something?
Well, no, I was actually across the street in the National Indemnities building. But yeah, I've been in that office. It is a very tiny office. The conference room is about the size of most people's desks. It's amazingly tight.
I'm sure you developed a taste for cherry Coke while you were there. So you were in on the ground floor with Premia. So you founded this business. Give us a quick run through of where Premia's got to in that time.
Yeah, so we started out as a single, our flagships in Bermuda. That's where we based the business. We've then added platforms in the US, the UK. We have a Lloyd's managing agency and a London market company. And then we also have added a European business that's based in Antwerp. So we have platforms in the United States, in Bermuda, in the UK and Europe that allows us to write risk in all the key jurisdictions, which is important to us in our risk transfer business. And we added a complementary business to that in 2018, where we bought Allen Gray, which is a fee for service provider, and it complements, serves third parties. It's a 36-year-old business. We've added some bolt-on acquisitions to Allen Gray over that time. So today we have roughly 250 people. About half that's in our service business. The other half's in our risk business. And we have about $850 million of capital plus our sidecar that we put on in 2020, which is roughly gets us to about $1 billion in capital.
That's a really good rundown. So in terms of that platform building, it seems like you've kind of got all the tools in the set. So we'd be right to assume that we wouldn't expect to see you opening up new platforms.
Yeah, I think we do. I mean, there's always a look at Australia every once in a while is a place where a few deals get done. And so the right opportunity, we would look at that. And, the way we think about it is we take on risk in any form. So if it's insurance, reinsurance, or acquisition, we will do that. And so if that legacy deal is in acquisition form, we may add another company, but we have the platforms we need today. And sellers like to use Premia because we have a great record of getting approval for acquisition. So they know when they do a deal with us that it's going to get through the regulatory authorities and be approved. And so, the execution risk drops when they do a deal with Premia.
Let's talk about the market. Where are you seeing the most opportunities right now?
So the United States continues to be the number one market for us. Long tail casualty business in the US is obviously a point of conversation and of interest to us and where we do a lot of our transactions. I would also add the structure of Lloyd's with reinsurance to close makes it an important market for us. And those are the two places I think we do most of our transaction. And then in Bermuda, you often get Bermuda to Bermuda deals, but they are based on largely US exposures.
So casualty is definitely where it's at. And of course, it's where it's at in the live market as well, where the most points of debate are. And of course, before this market hardening phase started in about 2019, we saw a lot of smart underwriters just did a lot of legacy deals actually around then, didn't they, to clear the decks and to sort of free their capital up to make the most of what they thought was going to be an improving live market. I've just done a podcast down at Monte Carlo at the Reinsurance Rendezvous. A lot of uncertainty, probably more uncertainty than there has been for a really long time around the US casualty market. What's your view on it? A lot of those live players have had deterioration on some of those back years from the teens, from 14 to 19. You are an expert in all this. You know all about deteriorating casualty years.
Yeah, well, we definitely see a lot of portfolios in that period of time. And I don't think there's much debate that those years have really underperformed what people thought they would be when they were originally written. And I know that's a bit of a generalization, and there probably are companies that specifically are doing better than that. But I think as a generalization, I think that certainly holds true that those years have underperformed. And I think what also happened a bit is that as you went into the pandemic, it also masked a little bit of how those years were performing because you had courts closed and it was difficult to see exactly the performance. But I think now that we're sort of 5 years past that block you've referenced, that certainly is underperforming. And many companies have taken different approaches. Some have reacted quickly to the data and have changed their reserves and their go forward pricing. Others haven't adjusted as well. So the market is still, as you would expect, there are people doing better than others. But I think as a general rule, that time period is pretty across the board underperforming.
So when you see that, is that music to your ears? Is that good news for you, Bill? Or you think, oh, you know what? I should be cautious as well. Obviously, my job is to remove some of these problem years. But, if you see a year that is problematic, do you want to run away from it or do you want to be able to take it on? Is it always reinsurable from a legacy perspective?
The early booking rate for the Data Jam on November the 28th expires this Friday. The Data Jam explores the implications of data, analytics, AI, and automation for all sectors and business lines within UK insurance. Join 500 of your peers discussing everything from data quality, standards and governance to AI and algorithmic underwriting. Hear keynotes from Dan Robertson, Chief Data Officer at Bupa, and Tony Fish, author of Decision Making in Uncertain Times, and choose from 25 workshops and breakout sessions featuring insights and case studies from Admiral, MetLife, Aon, AXA, WPA, eShore, Gallagher Re, Brit, Wesleyan, Zurich, and many more. Book now at data-jam.co.uk. Practitioners pay only $249 plus VAT. Suppliers pay just $499 plus VAT, but only until 5 p.m. this Friday. So that's data-jam.co.uk for the UK's #1 event for data in insurance.
I think it is important that people address those years with wide open eyes and see what's developing in that. And I think there's a bit of still a bid-ask split on those years, right? And certainly in 2023, the legacy market was down and the number of transactions done. I think some of that was related to the market having a different view on those years in particular. And so now another year's gone by, another card's been flipped over, people have a better understanding of that. And I think that bid-ask spread is narrowing a bit. So we're happy to look at those years. We do a lot of transactions involving those years, but it always has to be priced accordingly.
You've got to make sure you get your buffer so you can make your return. You're not a charity. You're not coming in to take away their problems without charging for it.
No, I think a fair price for the risk is what we try to do.
And that time when some of the more astute and more nimble underwriters, live underwriters, were clearing the decks, I would say, ready for a harder market, there was a point at which some of those deals, they weren't actually very seasoned years. They were actually putting to legacy some of these not mature years. And that was something that the legacy market seemed to be okay with. And there was almost a moment there where I was thinking, how close to live could legacy be getting? Where do you think we are at the moment in terms of that maturity factor? There was certainly a time when more progressive legacy players were almost live. And like, if you've written it, yeah, I could take it off your hands now kind of thing. It was almost like that. I mean, I'm probably putting words into your mouth, but how mature does business have to be now for legacy to have an appetite to look at it?
I think it's always helpful if there is some good history that allows you to price it. But we definitely see deals that are fairly recent. And I think, though, in today's market, that's probably less troublesome than where it was a pretty underpriced market and it has developed that way. I think today, most companies, if they're doing something that involves 2023 or 2022, they have gotten some decent rate change, and we're able to see that in the data. And so it's less troubling to us if it's more current on the casualty side. But yeah, no, in those back years, I think it's an old story of the insurance industry. There were too many valuing growth over underwriting discipline, and a lot of our legacy market compatriots got into some issues jumping on those deals where they were highly focused on growth. And unfortunately, from my vantage point, that was pretty foreseeable, but the market's a long feedback loop in the casualty space. And so it takes competitors and others a while to recognize that. And so that underpricing went on for a while before I think it's become more market discipline.
Well, I should have had you on the podcast then, but I suppose actually the podcast didn't quite exist then. I remember writing in that 2014 to 2019 period, we're probably writing more about everyone being pretty bullish. And we're talking about ceding commissions on reinsurance deals going up year on year most of the time, and everyone having a very favorable view about that underlying book. And of course, yeah, how things change.
Oh, definitely. I think that's part of the reason when I was making the decision to leave as chief reinsurance officer at Chubb, I had really good insight into where the market was and where pricing was. And it felt like there was going to be a shift in developing those years. And it was a good time to get in the industry with fewer competitors and less clear on who the successors would be at those competitors in the business.
And so with some of those, we've had some troubles. I mean, things periodically bubble over in legacy. Of course, we've probably had, let's say, from a news flow perspective, perhaps more negative stories than we've had for quite a long time. What do you think is likely to be the result of that? Is it consolidation, that kind of thing, or huddling together for warmth in the cold climate?
I don't know if there needs to be further consolidation in the space today. I think a lot of the players have thinned out for sure, and there is less competition at the higher end. I mean, I think we see ourselves as one of the markets that our distribution partners regularly in touch with, and I think we see most transactions. But you can definitely see on the deals there are fewer markets, and it seems to be the market's a little more rational in how they're approaching it. So I'm not sure there's going to be more consolidation. It's always a possibility. I mean, scale is a benefit to the business, but there's a lot of issues that make it difficult to consolidate, just like there is in M&A in the regular insurance industry. It's also the same in the runoff industry. So I think Premia remains a stable and dependable market, and I think we're in good shape where we are.
And I suppose if there was consolidation, it would be you doing it.
Well, I think there are a few players who are in the right set to be doing that for sure. And, we certainly have looked at transactions. We ran off the armor for Aqualine, the owner, and helped handle that in not quite a consolidation way, but a fee for service administration way to reduce that portfolio and close it down for them.
Something else has happened. Well, but in legacy, we don't really have many publicly quoted companies. Obviously, we had one quite well-known one, which is in the business of going private. Do you just think that the way the legacy business is structured, do you think it just suits being a privately held company, not having to, go to investors every quarter and explain what you're doing?
I think the lumpiness of the business, I would say it's more suited for being a private company, as you say. Because of that, it's a sort of lumpy, right? We don't have the 1-1, 4-1, 6-1, 7-1 renewal calendar like a normal reinsurance group. And so it makes it difficult to give guidance and forecast results because of that lumpiness.
Yeah.
That said, there are lots of businesses that are lumpy that are public that have done well and performed well. And so I don't think it's a binary. And I certainly think you could have a public reinsurer that's focused on the legacy space. But if you sort of get to what's it best suited for, I would agree, best suited for private markets.
It's difficult to analyze, isn't it? Especially if you spend all day looking at live markets and you're saying, well, where's the combined ratio? Where's this? Where's that? And what am I supposed to be looking at? How do I know whether they're doing well or not? It's very difficult. It's a different skill. And it's not one that necessarily many people certainly the analysts or the financial journalist community have.
Yeah, it's a niche within a niche, right? Which makes it difficult for a lot of people to know a lot about. People have a struggle with knowing about reinsurance, and then you get into the legacy market within the reinsurance business. It is a small community.
Well, I suppose the last time I did an episode with anyone from the legacy space was probably about 18 months ago, maybe 2 years ago now, in fact. What's interesting about legacy is that you seem to have a very different investor pool than the live market does. And that therefore you can have a completely different kind of investment cycle, investment view of your sector or your subsector, your special niche sector within a sector than the insurance market does and the live insurance market does. And the last time I checked in, we were at a time when investors in the live market were kind of on strike and not going to be giving any new capital to the industry until it sorted itself out. But actually, we're very, very happy to be giving funding to the legacy side of the business. It was a kind of hard market in funding for the live market and a very softish, or anyway, very pliant and very happy market, willing and ready to invest with lots of capital available to invest in the legacy market. Where do you think we are now? Obviously, the live market, I can report on that, but where we are in terms of the willingness and appetite for investors in legacy. If you had a really big deal and you knew you would need new funding, another sidecar or something, or maybe even new equity, would you be able to go and get it easily?
Yeah, I think so. I mean, I think you need a good runway to sort of be able to see when you need that capital and how to deploy it. And we've turned down capital and we get a fair amount of reverse inquiry into Premia and do we need capital and, what are our capital plans? Every time we've tried to go out and raise capital, we've had a lot of interest, and our disciplined track record is supportive of that. I think the market out there, just like it is for the live business, demands performance and wants good returns. And so you have to sort of be able to deliver on those things. But I think the capital is there for Premia for the right opportunities if needed.
And what about in kind of the global macroeconomic situation? Obviously, now we can sit and say almost for the first time in 20 years that we've got risk-free returns are available to us. How do you view that in the legacy market? It's got to be a good thing, right?
It is a good thing. Yeah, I think it's really a good thing for our clients in particular, right? If you think about we value transactions on a present value basis as opposed to a nominal basis, that having real interest rates allows us to discount at higher amounts, which is good for our clients. And so I think that is a boon for us and for our clients. And I think in a world where now equity has a real price, the efficiency of doing a reinsurance transaction is much more appealing than it's ever been.
Yeah, it was much better than when there was negative interest rates and you're sort of charging up front to take away something. At least now, yes, there is a prospect of having to part with less cash than you would have had to before.
Yeah, for the seeding companies, that ability to pay a present value of the number is certainly appealing. It depends on what accounting standard they're on. But in, US GAAP, it's generally they're on a nominal basis. In Europe, obviously, it tends to be more discounted depending on where you are. But still, it matters to the clients on making sure that transaction makes sense and they get that built-in present value discount is part of the pricing. Now, you have to charge for volatility around there, carry number and all that, but it does improve the pricing environment for clients.
I'm always having innovators on this show. I'm trying to catch up with whatever's new. Legacy is in itself, it's part of the innovation of this great insurance ecosystem that we're all part of. There was a time when it was a new thing, and certainly standalone legacy companies with a brand and with nice offices. That's something that's happened in my insurance career. And it's a very positive thing. And now an alternative career path within insurance. What sort of innovations are you expecting to be coming down the track within legacy?
Yeah, so just on your first point, I do think it is an interesting time, right? And I think Premia is an example of that, where we are a group of individuals who have been successful in the insurance and reinsurance space, and we've decided to focus our careers on the legacy market as opposed to we ended up in the legacy market.
Yeah, it used to be that there was a semi-retired underwriter was eking out the last few years before they could collect their pension. That was my first experience as a young broker, going to do an endorsement on a very long defunct policy, that kind of thing, and that was my first experience. It was a bit dusty, not a glamorous career path, but perfectly nice way of making a living, but not something you would necessarily recommend to your children. Whereas now, you go into a legacy company and it looks just like a live company. It's kind of got nice offices, a bright working space. It looks like a happy place to be, and there's a lot going on. It feels quite dynamic, and it's just completely chalk and cheese compared to what it was.
Yeah, I think the talent we've assembled is as good as any in the space, right? And so we're happy, and we think that is where the market should be. But getting back to your point on innovation, I guess what I would say, there are two areas where I see sort of innovation coming down the pike, and they're a bit related. But one is the market in the legacy space has always been a one-off transactional market. And I think you're going to see more deals because the clients are talking about them and we're interested in them, and it goes to sort of the capital management tool is having a repeatable business model, right? So you end up doing a deal with a client who says, I'm going to put in, for example, 2014 to 2019, and then every year after that, I will roll in another year, for example, of my casualty portfolio, and we'll just continue to do that as a way to have a constant way of capital relief. And both sides sort of have this guardrails around how that transaction will be done. But I think it'll be a much more repeatable business going forward.
Yeah, like a continual contract. Presumably you're not signing up for a multi-year deal, but you're almost having a memorandum of understanding. And it's a partnership kind of model as well, isn't it? Again, you've got to pick your partners.
That's correct. So it's not a guarantee that they're going to write the next year for anybody, but it is an understanding that that's the intent and everybody's operating to add that next year into the program. The other side of that, which I think is somewhat related, is you see in the ILS market that they start to move into the casualty space. One of the things the ILS investors are going to want, just like they wanted in the property cat space, was an exit strategy. And I think the legacy market provides those ILS investors an exit strategy as they move into the casualty space. And that sort of ability to quote those at the end of their term is an important step in sort of expanding the ILS investors' appetite for casualty business.
Are those likely to be almost sort of preloaded, that they know what the exit cost is going to be up front? So it's often these typical sort of 2 or 3 year deals, for example.
Yeah, I think it's difficult to guarantee the price up front, but you can guarantee a methodology on how you reach the price up front.
Right. This percentage of outstanding, et cetera, that kind of stuff.
Right. That's some view on how you're going to come up with determining what the remaining ultimate is, and then how you discount that back and settle it up will be agreed.
Kind of like when you come off a proportional treaty, there's that kind of portfolio in-out segment of that agreement that, let's say, I didn't always understand when I was a placing broker, but you really understand it when you do the portfolio in-out, then yeah, it means a lot.
Yeah, Mark, I think that's a good example of sort of the idea of it is right. And I think that is for these investors who are like, I don't want to be in the casualty business forever. I want to be in the casualty business for a set number of years. That'll be important to them. And I think it'll be transformational, frankly, to the space.
That's really interesting, particularly as getting into all sorts of, when you've got cyber cat bonds and of more pure liability cat bonds as well. And you'll be their ability to have that liquidity and to take their profits. Well, hopefully profits for them.
And whether it's in a bond form or just in a quota share collateralized treaty or however it's done, I think there's a lot of different formats that a lot of those ILS investors participate in, and we can provide a solution for them on the back end of that.
Anything else coming down the track?
I think on the innovation side, those are the two areas I see in the more attainable time period.
Let's go back to that first one. It would mean, yes, that you have your kind of roster of your preferred partners then, aren't you, at that point? And I suppose then that would also mean that some of the people that are not your preferred partners probably are going to be preferred partners of somebody else.
Yeah, I'm hopeful that we don't exclude anybody in these conversations, but at the end of the day, it's a capital management tool. And I think people are viewing that more and more as an important piece of their capital management tool is the legacy space. If I look back at this, I placed cat bonds in 2006, right? So if I had to think about the time when I was doing that back in the market, it doesn't feel like legacy is too different from that, where we are sort of becoming more recognized in the market. It's not viewed as just an alternative capital that's kind of out there. I think you have much more mainstream companies using it. And I think at the end of the day, just like cat bonds are today, you will have most of the major companies looking at legacy transaction as a way to, frankly, become less capital intensive on their business, take business that they've already written and recycle that capital into their new business. And in today's environment, that's really attractive, right? Because you have what a business that looks like it's a high teens ROE business today versus the back years. And if you can take some of that capital out and recycle it in, it's very appealing. And I think that ability to sort of continue to do that over and over will be more attractive to companies as we move forward.
Yes, if you can make those numbers work, their rating, if they're a public company, for example, will go up. Their rating amongst analysts, their price to book rating will improve and it will pay for itself in many ways, I would have thought. Actually, on that lighter capital structure, again, you've got a sidecar. So again, how far do you think legacy can go into that, having a lighter capital structure itself? Again, you could be a manager of other people's money and they can be taking the capital risk against what you're doing on their behalf. Again, how far do you think that could go within legacy?
I think it's important to have a base capital setup. And I particularly, as I ran the reinsurance security committee at Chubb for that time period, I was always telling people you had to have $500 million of capital in your company to be on our approved list or to do a transaction with us. And so I feel like I should have to live by those sort of rules. And we've sort of operated on a view that was where we started out, minimum $500 million of capital. But I do think there is the ability to find other ways to bring capital in that was less permanent and more fit to purpose on a particular transaction. And I think there will be definitely institutional investors, family offices that look at those things as attractive opportunities to do. And we will take advantage of that when the market opportunities arise.
That's really interesting because I suppose it's hard to go and sell finality if you don't have any capital of your own. People say, well, hang on a minute. Where's your money bags? I want to go and look at your bank vault and actually touch your gold bars and your gold bullion to see that, you've got capital. This is a very important part of what you're doing in giving me finality. So we're not going to end up with a sort of the legacy equivalent of an MGA.
No, I think it's important that that promise to pay has some real support behind it. And, we think cutting that too thin is not the way the industry should be reacting. And bigger deals require bigger balance sheets. And we tend to focus on the larger transactions. So it's appropriate to have better capitalization.
I couldn't be sitting in 2024 without asking you about AI. And what's been amazing about artificial intelligence, AI, seems to have applications all over the place. Again, people have come on the show and spoke about the applications within claims. Do you see any applications within legacy space and obviously capital allocation, all sorts of things? Are you experimenting with it and finding anything you can use it for?
We're experimenting with it. We haven't broken it out of the shop yet. I think before we get to artificial intelligence, there's a lot of human intelligence that we can raise and bring to bear in this space that we're looking to do and try to get better at execution every day is how we work on it. But we do see in that space, I would agree that claims is a fantastic area to explore. I think reinsurance processing and administration is an area that getting those headcounts and that down in that area, AI is well suited for that. And then just due diligence is generally as you go through big books of business and being able to perform some of that due diligence is an important area that I think all three of those areas, claims, reinsurance, and due diligence generally are ripe for AI initiatives.
Particularly when you're looking at a new book and you're being offered a new book, a substantial book with lots of claims in it, if you could let loose some sort of indefatigable agent to go and read all those claims files, that would be pretty cool, wouldn't it?
And there are some people who are working on that today. We're looking at adding that to our arsenal to help in those scenarios. So I think there is real application for that in our space.
What about litigation as well? I mean, again, as something to go through your book and say, well, actually, these are the ones I think you should definitely defend forever and fight these claims all the way to the Supreme Court if you have to. And these are the ones which I think actually you're probably far better off settling them now, and this is what I recommend kind of thing. Do you think that's a possibility?
Yeah, I do. In fact, in our service business, we actually have a tool called Claim Savvy that does a little bit of that. It helps the people identify claims and valuations. And I do think the industry needs to get more sophisticated in planning for trial and preparing for that and figuring out ways to get things like jury verdict research done at a cheaper cost and do it more often because we tend to only pull that out on mock juries and the like when it's a bet the farm case. And I think there's a lot more opportunity to employ that if you can do it at a less expensive way to help the industry. And so I think there's a lot of opportunity in that on handling litigation and claims more generally, for sure.
I've run through my list of questions. It's been really good having you on the show and seeing a big smile on your face, which is good. I want my legacy partner to have a smile on their face. Not too big a smile, obviously, but, a good, healthy smile. And I want to see them looking optimistic and happy about the future and also all the finality they've given me on all the things I've already given them. So you're looking really well on it, Bill.
Thank you, Mark. It's something I love to talk about. So I appreciate the opportunity to join you today and go through this. And, it's exciting times in the legacy market. And I think it's lots of opportunity ahead of us. I think the market for Premia and legacy generally is an important space for the industry and a real value creator for us and for our industry brethren.
Well, long may it continue, Bill. I really appreciate it. And thanks very much for coming on the show.
Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.